Hello and welcome to this another special episode from Weekend Investing. We are trying to give some education on financial planning, on markets, on various nuances of market operation through these series of content. There is nothing new in the content that we are presenting here, but we try to present it with some data backing so that it has more impact in terms of your thought process. And while you already know all this, repeatedly hearing and seeing the impact of the same can have a very lasting impact on your psychology, and that may help you in your investment journey. That is the whole idea right here. So this is another one of those uh, subjects. Economist Benjamin Franklin says money makes money, and the money that money makes more money. So you need to make money, and that money has to make more money, and that's how the cycle will go. You yourself will not be able to be that source of generating the additional money, but you have to allow the money that you made to make more for on your behalf. So you almost like get a partner. So your portfolio should become a partner uh, of you, who eventually makes much more money than what you are making, and so that you can take a step back perhaps and allow that uh, relentless and endless partner to keep churning the green bucks for you. So we will discuss the 15-15-15 theory here. This is nothing but a very simple financial planning thesis here. We'll use a SIP step up of 2.5% annual. So what 15-15-15 means is you're doing a 15,000 monthly SIP, but every year you increase it by 2.5%, which is actually very, very conservative. Over vast spans of periods, 5 years, 10 years, you'll find that your income levels will go up quite dramatically, and 2.5% should be very, very easy. But just for simplicity's sake, to be most conservative, we're taking 2.5% here. So 15,000 is the monthly SIP amount. It could be any amount, but we're taking 15. 15% is the assumed XIRR on your investments. Best if we assume it sort of post-tax. And 15 years is the period that we will take. So 15, 15, 15 is the thesis that we'll do. There are two phases. First phase is 15 years, which is slow and steady building blocks. And then the second stage will be the exponential block. So let us visualize the impact of this investment in form of two charts. So current chart is current investment and current value. So here you see the first 15 years, and you can see that year one, you do a current investment of 1.18 lakhs, and at the end of the year, you end up with uh, 1.96 lakhs. The next year, you're making a starting off with 3.65 lakhs, and you reach a value of 4.27, and so on and so forth. And in year 15, your current investment is at 32, and your current value reaches 105 lakhs. This is the current investment and the current value chart. If we now look at uh, milestones in this journey, you'll see that the first sort of point where your current investment almost reached 18 lakhs in year 9, and your value became nearly 36 lakhs. So this is where your first doubling of your current investment was achieved in year 9. And then in year 14 is where you will achieve a tripling of your uh, investment of about nearly 30 lakhs and nearly 90 lakhs. And milestones, will test your patience. 9 years and 14 years is not a small period, and we are starting off with a small base, just for simplicity sake. But and the other variables that are huge assumptions in all these extrapolations is, of course, that the market is stably giving you 15% XRR, maybe even post taxes returns, and the fact that your financial journey at your end was smooth. There was no loss of job, no personal tragedies, all those things that can, make you go away from this path. So all that is assumed here. Obviously, we have to assume an ideal world, and then maybe you're not putting in the unexpected gains also. You may get some bonuses, you may get some inheritance, you may find a better job, you may get some bonanza from somewhere. Those also are possible in that. So now, unfortunately, most people will not cross stage number one. So this first stage where money has started to grow, not even doubled of where your current investment is, most people will not reach this place. In fact, if you go with the AMFI data, the Mutual Fund Association data, the average mutual fund holder does not stay in the market for about 18 months. That is approximately the, I mean, when I heard this, and I heard this recently, I was shocked out of my mind. You know, that is supposed to be lazy money, not active at all, just put it, shut it, and forget it. Even that money is on average not spending more than a year and a half in the market. So it is extremely, I would say, likely that most people, maybe not our viewers, because somehow people on Twitter, for instance, uh, or weekend investors, I can say, are extremely mature audience. But if you talk to somebody who's not looking at the markets in such a focused way, for them it is like, I'll try 5%, 3% of my assets into this and see in a couple of years what happens. And then usually what happens is that most people will come in somewhere near some cycle top, and then the next 2 3 years will frustrate them like hell, and they'll just go away after that. So that is the larger audience, I would think, and that's why the data from AMFI is relevant. So most people will not cross this stage. So the idea is that come what may, cross this stage. Even if you are bleeding like hell, you have to cross this stage and allow your journey in the markets for long term. That is the key. I mean, I don't care about returns, whether you get 15, 20, 25, 12. That is okay. I mean, you will compound, but if you don't stay in the market, you will not compound. That partner that you were going to get is not coming, right? Then you are slogging all your life, and at the end of it, when you retire, there is nothing much to show. So current value of 2x 3x is not reached by a lot of folks, and the reason I have just uh, discussed. Chart 2 is the magic of yearly gain. So in this chart, what we are seeing is what is the gain per year and the investment per year. So for instance, in the first year, we invested 1.8 lakhs, our gain was 0.16. Next year, we invested 1.85 lakhs, our gain was 46,000, and so on and so forth. So when we see this chart, and you will see by sixth year, your annual investment into the market may result in a equal or more gain from that year. I mean, that is, of course, it's not just that investment, it is all adding up from here. But nevertheless, I mean, the net additional gain that you get from year 6 is equivalent of what you put in that year. And then in year 9, what you put in that year, you get double out of the market that year. Then in year 11, whatever you're putting in the market, you get 3 times more. Year 13, 4 times more. Year 15, 5 times more. So this gives you, enormous encouragement, if you see it this way, to stay with the market. And this is how the ball rolls, the compounding happens. And I have seen in my own journey also, although I did start very, very late in terms of, having long-term compounding going on for me. The numbers tend to, mind boggle you as that curve kicks in. I mean, you would not imagine that, outside anywhere, with making some other investments, you would get that kind of a, auto kicker. So, I mean, from my case, I am blindly sort of monthly putting in whatever savings as I can. And then the numbers that show up, you really surprise you, right? And of course, once you have built that, once you've crossed year 6, for instance, and your kitty has become reasonably, maybe nearly double or less than that, actually doubling happens here. You have to quickly reach a point where even the worst market scenario does not really take you away from, your larger that capital that you've invested. So my pet sort of advice to many people who've never come to the market, they say we have 100 rupees all invested in FDs, some in gold, some maybe some real estate rental is coming, but we don't have any equity. So how can we, I mean, when we are very afraid. So the best thing is you put 10 rupees out of those 100 in the market anytime, even at the market peak. What is that worst case scenario that will happen, let's say in 3 years? Either that 10 rupees will become 5 or that 10 rupees will become 15, more or less. If it becomes 5, your 90 has made enough in 3 years so that at least in over 3 year period you've not lost capital. And if that 3 year is good for other assets also, and you've gone from 10 to 15 on this, then you have a good buffer for adding, more into this. So that 10 can go to 20, that 20 can go to 40. So this is how, when you build buffer as you go along, your base capital does not get damaged so much, even in the worst market scenario. So the worst market scenario would be 2008, 2020, 2018 fall, 22% fall, 2018, I think 35% fall in the market index, I'm saying 2020, and about 65-70% fall in 2008. But before each of these falls, if you were in the market for 4, 5, 6 years, your capital would not have got destroyed, for sure. So that buffer is essential for protecting you from that. So this is where the second phase comes in, after you've built your building blocks for the first 15 years. And then, phase 2 will kick in, and that number that we have taken, 15,000, it could be 50,000 for some people, it could be 1 lakh for some people, it may be 2,000 for somebody. So that is just an example that we have taken. So now see the explosion that will kick in the second phase. So first, phase 1 takes 15 years to get to your first crore, and then, next 15 years, can you imagine the price, the end result? It's very difficult to imagine, actually. So end of 30 years is 10 crores, uh, whereas end of 15 years was 1 crore. So you went 10x in this time period, in the same time period. Of course, you are continuously adding 2.5% additional step up through this, and of course the big assumption is that you will be able to make 15% IRR on this. So the idea now, if we go back to this chart, so this starts to go exponential. So 2 crores go from 1 crore to 2 crore in less than 4 years, 2 crores to 3 crores goes in 3 years, and then to 4 in 2 years, and then to 5 almost in a little more than a year. And then every year, you are just adding, for instance, in this year you're adding, total investment is 68 lakhs, but your portfolio value is at 6.5 cr. So essentially, while nobody's portfolio outcome is going to be looking like this, it may be, all over the place. It may go up earlier, may have a dip, then go up. But you can get the idea that if you are able to create a very balanced portfolio with proper asset allocation also, overall your net worth can grow like this, for sure. For sure. I mean, there is no need to run after 30, 40, 50% kind of returns. Double digit returns, even if low double digits, high double digits, you will get that hockey curve in your life, for sure. So the idea is that patience is key. So the biggest problem with most investors is not staying put in the market. And the first few years are the most crucial. It may so happen that if you jump into the market at the very top and you're gradually bringing in money, maybe for the first 3 years, it may become extremely frustrating that no gains are being made. I am putting, significant part of my take home salary into the market and nothing is coming out. That resistance, that you have to somehow mentally resist the idea of giving up. That is the key, I think. Uh, I remember there was one time, I think maybe late 20s, I started doing this, and dot-com bubble happened at that point of time. So 2000, not late 20s, early 30s actually. So 2001 to 3, those 3 years, my portfolio was just bleeding, bleeding, bleeding. It became so frustrating at that point of time that I just sold off whatever I had. I said, I'm not doing this right now. I'll do some trading or some other thing. I can't hold on. So that exactly was the bottom where market, started to pick up after that. And then of course I rebuilt over a period of time. But had I not given up in that, downtrend of 2, 3 years, the outcomes could have been very, very different. Anyhow, so compounding will take time. It will test your patience. Um, you have to believe it to really uh, gain from it. It's like an eternal truth that you have to believe. You can't question it, and your mind will is not wired to even think about this. If my net worth is 100 rupees today, I know mathematically it will reach 1000, but I can't even describe that journey, how it will happen, but that compounding is happening. So if you believe in that, then you will not question your decisions again and again. That is the problem, and that's ruthless and relentless discipline that is required. So trust the process, stay committed, even when results are not visible. That is the bottom line. Even when results are not visible, you have to stay committed to your path. It is just like, a Olympic sports person prepares for the Olympic, and then that result is not there at the end of 4 years. It really does not mean that they should be giving up, right? I mean, you were almost there, but yeah, because of some situations, you were not there. So but your game was there, and so you keep playing that game, and eventually it is likely that you will get there. Of course, instant gratification is the major uh, hurdle for youngsters, uh, because there's so much FOMO, there is so much social media pressure, there is peer pressure. Everybody in your office is jumping. I've got a 10 bagger and 6 bagger, and I bought this and I bought that. So you feel that you did a mistake. You went to the wrong mutual fund. You maybe went to the wrong small case. You bought the wrong stocks. Others are doing better. Others are growing faster. All that, you have to put horse blinders. There is, I mean, if as long as you're learning from others, that is fine. But whenever you will start comparing your returns versus somebody else, you will be disappointed, because there will always be others who are, you know, uh, growing faster than you, for instance. So this comparative of performance is simply a waste of your energy. And of course, power of time, as I mentioned, those who will stay in the markets for the long haul, the markets will reward them. Uh, that is the nature of the market. So, and we are of course fortunate to be living in India, where we have a automatic sort of a growth path for several decades ahead of us, and it has been seen that come whatever may be the uh, your government dispensations, policies, India manages to grow, and that is the sort of runway that we have, that we just have to sort of not do anything really silly and just follow along. So that's all I have for this session. I hope some youngsters especially will take some heed and look at longer term staying in the markets with proper planning, proper approach to the market, and not you know uh, fussing about the fact of returns. I mean, I think returns has taken over everybody's imagination in such a big way that they're losing the plot by not appreciating the power of even compounding at lower returns. I mean, if you take the example of Warren Buffett, I don't think his returns are phenomenal. It's only the time spent in the market by him is phenomenal. He started at whatever 11, 12, 13 years of age. He's now 90 plus, and most of his wealth has been made post the age of some 55 or 60. So it is not about returns actually. It is all about time in the market, and keeping to your process, that is hopefully self-repairing, and self-correcting mechanism that you figured out, or you're following something that is going that way. Let me know your thoughts on this in the comments. I love to read your comments, and I try to respond to each of them also. Do send us more feedback on our videos. Do share these videos, and I'll see you in the next one. Bye.